They're blaming it on risk management, but the silver futures machine recently tightened the screws just as the March delivery season is getting loud. Furthermore, I had no intention of creating this video. I'm actually trying to act like I'm off the grid for 5 minutes while I stand here with a half-cold cup of coffee. While perusing the most recent warehouse totals and margin updates, I couldn't help but wonder, what is going on with silver at the moment? The loudest headlines are giving you the sloppiest tale, and I believe you should be given the whole story, which is why I find it annoying. So here it is. Monday, February 9th, New York time is today. I'm really interested in how far this message spreads, so please leave a comment with the day and time you're viewing from. Quick thing too, I'm spearheading an effort to get rid of imitation channels. To let the algorithm know who you support, please subscribe and leave a comment for future Ledger Anna if you enjoy this material. It won't take long, so here's what we're going to do. I will deconstruct 3 things. First, the reason why the figures individuals are reporting seems so severe is because of the panic that really started this current wave of March. Second, the system has more methods to withstand strain than most people know, which is why a complete failure is not the worst-case scenario even when the market is under extreme stress. Third, what to keep an eye on over the following few weeks to avoid just responding to noise as though it were a fire alarm. I'm not requesting that you have faith in vibes. Based on the most recent margin revisions and publicly available warehouse totals, I'm requesting that you take a look at the plumbing because this is one of those situations when the mundane details are more important than the chart. You've probably heard this phrase a lot if you've been around commodity desks, metals talk, or even just your group chat with that one friend who suddenly became an expert in silver. The system is likely to collapse in March. And perhaps it will. I don't think the clean cinematic collapse is the most likely scenario, but it's not an insane dread. Not because everything is good. It isn't. This is because the price chart doesn't display the numerous levers, trapdoors, and escape hatches that are part of this system. You'll see why the apocalypse can still be delayed and tension can be genuine in a few minutes. Let's take a step back, because every frightening screenshot someone posts will emotionally hijack you if you don't know what delivery actually means in this industry. Silver is traded as if it were 2 distinct universes posing as one. There is the actual metal, bars, coins, industrial feedstock, and other items that must be present when a factory needs them. Then there is the layer of paper, contracts, exposure, and pledges. The majority of paper layer employees want a price, not a truck. It may seem apparent, but that's the whole point. People typically imply that the amount of silver that is now tagged as deliverable under the rules is less than the amount of paper claims that may theoretically request it when they state that the exchange is running out of silver. And because the paper layer can grow quickly, that gap is where the drama takes place. It's essentially instantaneous. Position created, click, click, click. The physical layer is unable to. Because a spreadsheet indicates that you require a bar, you are unable to spawn one. Here's why March keeps approaching. One of the most important delivery periods on the calendar is March. Huge stories come with huge months, and this one is no exception. However, March wasn't the beginning of the story. According to reports, January and February became peculiar, which sparked the conversation. Typically, January is not the month when people decide to show courage. Typically, this is the month when individuals continue to act as though the year is just getting started. However, the figures that have been going around indicate that deliveries were in the vicinity of 50 million ounces. It's more like, wow, that's a lot of paperwork turning into metal claims, rather than a little higher, kind of elevated, or whatever. According to what people are tracking, it also appeared heavy in February, weighing about 20 million ounces. However, the raw ounces weren't really the main objective. Behavior was the most important factor. Instead of rolling away, an abnormally high percentage of open contracts seemed to stand. It was a considerably bigger chunk, not the typical little slice. The next question is, where does the metal originate from if that behavior persists into March? It gets strange at this point since most people assume that delivery entails a bar physically moving across the nation from a vault, much as when they deliver furniture. That isn't necessarily what it means, but it can happen. Delivery can occasionally result in the transfer of a warehouse receipt. It occasionally indicates that a warrant changes names within the same structure. Sometimes it implies that ownership moves, but the bar stays the same. Additionally, it occasionally indicates a side transaction that eliminates the future's obligation without the metal's zip code altering. Therefore, it is possible to have months with a lot of deliveries without seeing a truck parade. For this reason, you must comprehend the two warehouse buckets that are used by everyone as if they were magic spells. Deliverable stock, also known as the registered side or the portion of the pile that is already prepared to fulfill delivery commitments, is the first bucket. The second bucket contains qualifying metal that satisfies the requirements, is stored in vaults that have been approved but has not yet been marked for delivery. It is owned. It has been spoken for. It is more than simply a piece of complimentary pizza. Indeed, deliverables can be created from eligibility. Although it's not automatic, that is one of the system's large pressure valves. Owners are forced to make a decision, and they typically do so when the incentive is sufficiently compelling. Therefore, on a particular day, it may be accurate to say that the registered amount is only about 100 million ounces. Additionally, it's possible that the phrase eligible refers to a few 100 million ounces. The distinction between the two heaps, however, is what separates what is currently available from what might become available should someone choose to play ball, and it usually takes money to change one's mind. Let me add a little bit of new reality now before we continue. In a brief period, the exchange has raised margins multiple times. Additionally, the most recent increase caused the primary silver contract's starting needs to rise into the high teen% area. Because margins are not a headline, this is important. They are a weapon, or a control knob for the more courteous variant. The exchange turns the knob up if it wishes to quell speculation. The exchange turns up the knob if it wants to protect the machine. Additionally, you do not receive a vote if you are a leveraged trader and they turn the knob higher. You can either decrease exposure or increase money. You have those options. Therefore, the most useful component of the jigsaw is being overlooked by those who shout March default while disregarding margins. Additionally, the venue has made it clear that volatility metrics and risk models are driving these margin increases, so don't assume this is some once-in-10-year decision. They actually release contract volatility numbers for the future, much like a barometer of what the options market anticipates. The clearing side becomes anxious when that gauge spikes. Because the clearinghouse's whole promise is that we won't be the party that breaks, they boost the collateral when the clearing side becomes anxious. The micro lever is the one that most people seldom discuss since it is uninteresting and detracts from the drama. Cooperation can be rewarded by the market. If there is a shortage of deliverables and many people want them right away, the system can react by giving holders a greater incentive to mark their eligible metal as deliverable. Higher local premiums, tighter spreads, more alluring financing terms, and occasionally just a straightforward business transaction behind closed doors are some examples of how that incentive manifests itself. Every delivered ounce is treated like a brand new piece of metal that had to be sourced from nowhere in a lot of the delivery explosion discourse. Delivery, however, may involve rearranging claims on metal that was previously there. Metal shifting from one kind of holder to another is one possibility. The same bar may be economically spoken for in a finance deal in a number of ways throughout time, rather than being netted out. Therefore, it is true that delivery matters and might reveal genuine tension. However, it can also show internal transfer behavior and positioning. Delivery alone is therefore not the true tell. Withdrawal is the true indicator. Does metal depart from the network of authorized vaults? Because the system can play musical chairs for longer than the internet wants to acknowledge if it remains inside. Another element of context that is important for the why now query is this one. A single blob does not represent industrial demand. There are several conflicting uses that don't stop because traders are arguing. One significant sector that has been expanding quickly is solar manufacturing. The demand for automobiles is also expected to increase in the upcoming years. As electrification increases, industry research predicts that demand will rise significantly over the next 10 years, reaching a level close to 100 million ounces annually throughout the automotive complex. Data centers, electronics, grid hardware, and all the other minor details that people don't consider add up to a metal that is subtly becoming a necessary component of contemporary infrastructure. Is there a substitute now? Indeed, engineers are constantly searching for methods to reduce the amount of silver used per unit. Recycling can react, but it takes time to make those changes. March contracts are noisy, so they don't occur. Therefore, the physical side is not a loose rubber band, which is one reason why people ask, why is the silver market so twitchy? It's more snug than it was before. Small behavioral changes can appear to be a catastrophe because they can be when a vast paper layer collides with a narrower physical market. One more crucial detail regarding the warehouse numbers. The reduction in the deliverable line does not necessarily indicate that the metal has disappeared. Metal is occasionally classed. Metal is occasionally transferred between owners. Metal can leave at times. It's not clear from the headline which. The daily sheet is therefore a place to start rather than a place to end. That's why you should ask one inquiry in response to someone who says, registered as falling, therefore default. What caused you to fall? Because physical withdrawal is considerably more difficult to reverse than classification. Which brings us full circle to March. The tension is genuine. The calculations are accurate. But human choices determine the result. Who demands that bars be removed? Who stands? Who pays for availability? And who rolls? And pricing, spreads, and fear all play a role in those choices. This explains why the market may appear stable for days before exploding. Although margins don't produce silver, they do make it harder for consumers to afford to demonstrate by standing for delivery, which is a game changer. Let's now explore late February, a date that frequently comes up in these conversations. Near the end of February, you'll hear folks talk about a certain day as if it were some magical deadline. It's mechanical, not supernatural. The market passes through a series of deadlines as the calendar draws near to a contract month's delivery period. Assignment mechanics, last trades, first notice, and all the other tedious things that make opinions into duties. At that point, open interest becomes more significant since open positions represent more than just opinions. They could be a performance requirement. Therefore, it may feel like a pressure gauge is rising if open interest continues to remain persistently high as that deadline draws near. However, once more, and this is the point that most viral commentary omits, open interest is not synonymous with bar demands. Potential is open interest. Behavior is demand. Additionally, spreads, funding, incentives, and margin costs all affect behavior. Since math problems are popular on the internet, allow me to provide you a straightforward method of approaching the so-called math issue. In silver futures, the entire paper exposure can amount to hundreds of millions of ounces. That's not a conspiracy. When everyone is looking for a low-cost way to voice their opinions, derivatives markets grow to that size. However, the pile of deliverables is substantially smaller. Thus, the terrible situation remains constant. What happens if even a small piece of paper demands to be tangible? Yes, there would be stress, scrambling, premiums, emergency measures, and rule changes that infuriate people if a sizable portion of individuals did it all at once. However, since fear sells better than subtlety, this is the skeptic point that no one wants to voice aloud. The majority of big players who stand do not do it in order to stack bars in their living room. Delivery can be a component of the finance, hedging, inventory, and arbitrage games, which is why they are doing it. To put it another way, they may be accepting deliveries within the system. Additionally, the system may last longer than you might anticipate if the metal remains inside. When metal departs, the real break occurs. A paperwork issue becomes a physics issue when owners respond, "No, I don't want a warehouse receipt. I want the bar out of your network into my custody." Are there any indications that the physical demand is actually high at this point? Indeed. And that's when the new context comes in handy. Silver is more than just a toy for investors. This industrial input is being tugged in several different directions. Solar uses silver and continues to expand. In a robust year, demand for solar-related products alone may reach well into the low hundreds of millions of ounces, according to recently released industry predictions and yearly market surveys. Infrastructure for charging and electric cars increase appeal. Upgrades to the grid increase pull. Electronics and data centers increase pull. Additionally, a significant portion of the production of silver is a byproduct of mining other metals, which makes the supply side problematic. Therefore, you don't simply start producing silver because the price increased. For this reason, in recent years, tightness and shortfalls have been noted in the major industry surveys. Here's the twist now. Because the paper market might be pushed to dump holdings when margins increase and volatility surges, a dramatic paper crash can occur concurrently with a tight physical market. Additionally, we just witnessed a series of significant fluctuations, including a sell-off linked to policy headlines and tightening margins. Therefore, avoid making the mistake of assuming that a lower price means that the issue has been resolved. Price declines can sometimes just indicate that leverage has been cleansed. I don't want you to get bogged down in theory, so let's return to March. What are the real-world results? The first scenario. The market wavers. Many contracts are rolled. Although there are incentives to accept delivery, they are insufficient to dissuade metal from being eligible in size. The exchange maintains tight margins. The volatility decreases. Although March is dramatic, it ends. The second scenario. The inventory choreography is done by the system. Convert from eligible to registered. Bars have been re-tagged. Ownership has changed. There is a lot of activity that appears to be strain but is actually plumbing. The public discourse then shifts to, see, no problem. However, the recorded pile remains thin, and the tension is carried over to the following delivery window. The third scenario is the one about which memes are being posted by everyone. A group of large holders agrees to remove the metal. Not warrants, not paper, nor metal. You can get a real scramble if it occurs. The market as a whole begins to learn the hard way the distinction between price exposure and ownership as premiums soar, spreads invert, and exchanges react. I now want to address one inference that frequently creeps into these tales of fear. The notion that since a collapse penalizes the system, it would benefit common people. Be cautious. The system doesn't kindly grant you a victory in a truly chaotic situation. It modifies the regulations. Costs go up. It restricts conduct. It defends itself. That is the function of systems. Although the pattern is different, we have seen this movie in other areas. When volatility rises, the venue intervenes, trading regulations alter, and those who believed they were winning come to the realization that the rules were not created for them. Therefore, simply realize what it typically means in practice if you're sitting there thinking, I hope it breaks. More limits, more volatility, more strange settlement outcomes, and a lot of individuals being cut off. Now, what are you supposed to do with this? First, quit conflating strategy with excitement. Purchasing silver because you believe that March will bring pyrotechnics is not an investment. That's taking extra measures to purchase a lotto ticket. Second, be aware of your exposure. You might receive price if you are holding something that is made to track price. You don't necessarily have metal. Additionally, those two experiences may differ during a stressful situation. Where is your physical, if you have one? Who has access control? What is the exact speed at which it can be obtained? Indeed, I am aware that asking that question causes discomfort. It's important because of this. Third, ignore the popular videos and instead focus on the dull data. View the deliverable totals. Observe eligibles' behavior. Observe spreads and the tightness of the surrounding month. Keep an eye on changes in the margin. These indicators let you know if March is a noisy or tight month. Since the term backwardation is used like a doomsday siren, let's now discuss it. In essence, backwardation occurs when the short-term price exceeds the long-term price. Give it to me now, not later, in simple English. That can occasionally be a sign of true tightness. It may indicate a momentary rush for immediate supply, convenience yield, or financing conditions. Therefore, backwardation is not a verdict, but it can be a signal. What transpires with real withdrawals, real conversions from eligible, and real conduct into delivery dates is the verdict. I'm about to slow down and say something that could anger both sides. Permabull wants you to think that default is unavoidable. The Permix would have you think it's all a hoax. In general, reality is more dull and ugly. In reality, the system typically endures as the underlying physical market becomes more competitive in the background. And you're already ahead of most people if you can maintain that thinking without losing your cool. Let's take a brief digression into contract sizes as this contributes to retail confusion. An enormous quantity of metal is represented by a typical silver futures transaction. No, it's pallets, not a few coins. Although there are smaller variants, the large contract still contains the core activity. Therefore, institutions, industrial users, and major holders with logistical skills are the ones who actually govern delivery dynamics. Price tools and modest in-person transactions are the main ways that retail engages with its customers. Therefore, don't expect to see millions of people pulling up in pickup trucks when there is open interest. Consider managing exposure with fewer big accounts. Margin hikes are effective because of this. They target accounts that use leverage, which is another reason why the story may be misrepresented. A lot of visible activity can be produced by a small number of powerful people. I'd like to give you one more lens now, which is boring but crucial. Why would somebody convert metal that is qualified to registered? Because incentives, premiums, spreads, lease rates, and the potential to monetize inventory are some of the ways they are compensated, not always directly. eligible holders will have an incentive to intervene if the market begins to offer a higher premium for instant availability. The market remains eligible if it doesn't. Therefore, the question for March is not whether any metal is suitable. Will holders be encouraged to release it into the deliverable pool? That is the question, and that's a question of cost. I'm going to be a little cynical now because you deserve it. The rule adjustments would already be occurring more aggressively if the situation were really, clearly, and definitely going to blow up in a way that the venue couldn't handle. Rather, we are witnessing a gradual tightening of margins and risk controls. It appears to be a stressed but working system. It appears to be a system getting ready rather than giving up. Indeed, preparation frequently results in someone being squeezed out, which is why it can still generate chaos. Silver doesn't trade in a vacuum, so let's now relate this to the larger macro environment. We just saw a period where policy expectations changed significantly and metals prices reacted sharply. The dollar matters, real rates matter, and risk appetite counts. As leveraged positions is squeezed out, you can have a situation where physical is tight, but the price still drops. Tightness is not refuted by this. It just indicates that the signal may be momentarily overpowered by paper markets. And that's the explanation for why silver might have a possessed feeling. I want to be really clear about this now. As long as players continue to have faith in the settlement mechanics, a futures market can continue to operate under stress for an extended period of time. One type of liquidity is belief. Everything picks up speed once belief breaks. Because March serves as a focal point, a deadline, and a narrative that people can gather around, it is psychologically risky, even if the math is doable. Before we move on to what I'm doing, allow me to add one more piece of new background. The eligible total is many times higher than the deliverable registered total, which has been circling the low 100s of millions of ounces in recent public market updates. Deliverable stock is the narrow end of the wedge, but that combination is not always disastrous. It indicates that the market depends on incentives and collaboration is brittle when everyone is looking at the same deadline. I now want you to respond to these two questions in the comments section. First, do you believe the March delivery stress is genuine or merely a storyline used by traders to manipulate prices? Second, do you own silver because you don't believe the long-term trajectory of money itself, or are you in it for a fast trade? Indeed, it is possible to say both. Both are done by people. Simply be truthful about which one you are right now. Let me now offer you a realistic perspective on paper versus physical without resorting to the hyperbolic ratios that are frequently used. The notional size of derivatives typically exceeds the immediately deliverable stock in contemporary commodity markets. Since derivatives are mostly used for pricing and hedging rather than for bringing metal home, this is typical. However, when a higher than average percentage chooses to turn exposure into delivery, it becomes risky. The fraction that remains is therefore more important than the headline open interest. And for that reason, margin increases are quite important. They don't alter the entire document. Who can hold paper into the moment of truth is altered by them. I'll tell you something now that could help you save money. People who know the plumbing will use your feelings as liquidity, so you shouldn't be placing large bets based on delivery drama if you can't explain the difference between a price instrument and a custody instrument. They will. They always do. Now, if you're successful, tell others about it in the comments section to keep them inspired. This is where you can truly help yourself, so let's talk about what to watch over the next few weeks. Keep an eye out for any discernible conversion of eligible metal to registered. The system is tapping the buffer if there isn't a single day, a small movement, or a significant shift. Check to see if margins continue to increase. The exchange is attempting to further reduce leverage if it continues to tighten, indicating that volatility is still an issue. Keep an eye on the spreads during the first month. An indication of urgency is if the front month remains bid in comparison to subsequent months. Observe reported deliveries, but exercise caution when interpreting them. Inquire as to whether the ownership is changing or the metal is departing. Additionally, watch premiums in person. Physical availability may be the real barrier if physical premiums remain high even when the price of paper declines. Let me now discuss another aspect of the story, the location of the metal. Much of the authorized vaulting network is confined to a few major jurisdictions and a few sizable facilities. When things are quiet, that focus works well, but when people begin to consider withdrawal, it becomes a focal point. Because insurance and chain of custody regulations are important, and moving big bars is not an easy logistical process. Therefore, the next question to ask when someone tells you that the vault system has a lot of metal is whose metal it is and under what circumstances it can be moved. Ownership is important. Consent and availability are important issues. I will now address the derivatives critique directly as it contributes to the persistence of this issue. When a futures market aids in price discovery, industrial users planning, and producers hedging, it is beneficial. However, there are sporadic instances where the volume of paper overpowers the physical world when it turns into a massive casino connected to a comparatively tiny physical market. This does not imply that the system is bad. It indicates that the system's administrators will defend it and that the incentives are out of alignment. Therefore, don't base your personal financial decisions on the hope that the system will concede defeat in a way that will work to your advantage. Develop your financial skills by learning how the system protects itself. Now, what do I believe will truly occur in March? It's going to be messy, I believe. You'll see volatility, I believe. You'll see sharp movements in both directions, I believe. You'll probably see some shouting default and others shouting nothing burger. Additionally, the majority of them will be reading the incorrect metric. Additionally, I believe that the systems probably function to maintain the game, move responsibilities forward, encourage conversion from eligible, increase leverage costs, and deter non-serious people from delivering. You maintain the machine in this way, longer but not forever. Cool story, but what do I do tomorrow? Is a question that many people ask. Here's my response. It's not glamorous either. First, determine whether you are a gambler or an investor. Size down if a quick drawdown is too much for you. Emotional distress does not earn you extra points. Second, avoid using leverage in a market where margin notices and policy headlines can gap. Juggling knives on a trampoline is analogous to that. Third, treat custody as a decision, not an afterthought, if you want physical as a long-term hedge. Fourth, be aware of the rules and the dangers of having to adjust your positioning when margins shift if you're using paper instruments for exposure. Fifth, maintain your curiosity rather than your panic, because panic is how you give money to those who were ready. I'll end this by revealing one more unsettling fact. Much of the content in Silver Collapse is intended to give you the impression that you are in a motion picture. You're not. You're in a marketplace. Additionally, markets don't compensate for drama. You get paid for being punctual, patient, and disciplined. Watch March then. Observe the delivery. Keep an eye on the buckets in the warehouse. Pay attention to margins. However, don't let the narrative control you. Take ownership of the narrative. Subscribe if you want more analyses like this one without the same old talking points. Additionally, please mention Anna in the comments if you agree with the copycat campaign so I can identify you. Okay, so that's the map. Let's see what March does in reality now. As always, this is not personal financial advice. Rather, it is for discussion and education. Your advisor is not me. You should base your decisions on your own research and risk tolerance. I have no idea what your circumstances are.